Interest rates. The sky is falling. Okay, not really. While interest rates are at their highest level in 20 years, historically they still are really good. In fact, my first mortgage in 2002 was an FHA ARM loan at 6.5% interest. What's an ARM loan, you may ask? Adjustable rate mortgages are those that have a fixed rate for a certain amount of time and then can adjust after that. They typically carry a lower interest rate than you would get on a fixed 30-year product. A popular option right now is a 10-1 ARM. So many of my clients either buy a new home within 10 years or typically refi their loan within 10 years anyway. So a 10-1 loan would give them a fixed rate for the first 10 years, and then they can adjust every year after that. Now, you do want to dig into what that adjustment can possibly look like after that initial period. But if you have questions on that, reach out to me or a reputable loan officer, and they'll be able to explain some of the differences in the ARM products. Buy downs are another hot topic right now, one that I'm less of a fan of than I am of the ARM products, because buy downs are more of a short-term solution to higher interest rates. So a 2-1 buy down would buy your rate down by 2% for the first year, 1% for the second year, and then your third year and remaining would go to your typical normal rate. Now, sellers can pay for that buy down. You can pay for that buy down, but it can be somewhat expensive, and you're only benefiting for a couple of years before your interest rate goes back up to the normal rate. Buy downs could be good for someone who maybe is anticipating an increase in income over the next couple of years. They want to start with a little bit lower payment now and then gradually work up to what their standard or normal payment will be. But just remember, you still have to qualify for the higher mortgage payment, and that will be the payment you will have for the majority of the loan life. Much like the ARM, if you're considering a buy down, reach out to us or reach out to your loan professional, and they will be able to walk you through your particular situation and whether a buy down might be the right fit for you at this time. One of the questions I've been getting right now is what will happen to interest rates in the next year if we indeed end up in a recession? Well, first of all, what I'm hearing from many people is we actually are already in a recession. It just hasn't been officially named that yet. But historically, in the last 6 recessions, mortgage interest rates have actually decreased every time. Can we say for sure that will happen this time? Of course not. But in the last 3, interest rates have averaged a reduction of about 1% during that recessionary period. So if you're buying now but are concerned about the interest rate today, either the ARM product or potentially the buy down product could solve that problem, especially if rates in a potential recession do go down in the next year. It does give you the opportunity to refinance your current loan product. There are, of course, always expenses with that, but it could offset the long-term savings you will gain over the course of a 30-year fixed rate loan. In the end, the sky is not falling. Rates are still great. Buyers are still buying homes. Sellers are still selling homes. The market has shifted. Dynamics have changed a bit, but we're still in a robust market where you can find a home that fits your needs and lifestyle. If interest rates, whether buying or refining, are a concern of yours or something you're interested in talking about, reach out. We'd love to help or point you in the right direction. As always, happy house hunting from all of us at NewmanSellsHomes.com.